Well, let's keep the conversation going on the Fed and what this means for investors. We've got Priya Misra, TD Securities Managing Director and Global Head of Rate Strategy. It's interesting here, Priya, when you look at the market reaction to yesterday, it felt like there was a bit of a resetting of expectations after there was so much hope on a potential Fed pivot or a pause. Now that we heard from Jay Powell, where do you put the terminal rate and when does it all end?
Sure. Thanks for having me. So it was a nuanced message that the Fed was trying to convey yesterday. Slower pace, but potentially higher endpoint. And the focus remains squarely on inflation. And how quickly does it decline? Does it decline? How sticky is it on the way down? And so we actually revised up our terminal rate forecast. We were in the 5% camp before yesterday. Now we're thinking 5.5 by May of next year. And then the Fed keeps it there because, inflation is extremely broad-based. It has been sticky on the upside. We think it's going to take a while for it to come back down. And we're taking the Fed at their word. They're committed to getting inflation down. And so we think they're going to struggle to ease or even stop hiking until there are clear signs that inflation has downshifted. And so, we think they're going to continue to raise rates. I do think that the risk of a recession has become even greater because there are lags that the Fed cannot see that data right now. The impact of policy tightening, they're going to continue to tighten, and I think as the economy starts to slow down, their task becomes a lot harder because if inflation is high, even if the unemployment rate is rising, I think we can't get a preemptive Fed that can start to ease. So it makes the risk of a downturn in the second half of next year very high. We're actually looking for a recession in the second half of next year, and then the Fed starts the easing process really in 2024. So it's going to be a tough couple of years as the two conflicts of the Fed, I think the two goals of the Fed are in conflict.
When you say the risk of a recession is higher, how much more significant? If you're already looking at a recession in the second half of the year, how does that differ from where you were going into the meeting yesterday?
Sure. So I think we were anyway nervous about a recession because, it's not just the Fed funds rate. You look at the tightening in financial conditions, or you look at the 10-year. Most of us borrow at the 5 to 10-year part of the curve, and those rates have risen significantly, and it's been a real rate-driven increase. So we were anyway concerned that things are slowing. I think with Chair Powell, I think reinforcing the inflation commitment, not giving any room to letting lags play out or being willing to tolerate a slightly higher inflation for a longer period of time. I think these were all things that the market that's been waiting for a pivot was hoping for. And that's why we saw that big reaction on the statement, because it looked like the Fed was at least nodding to lags. But then it turns out, no, they might be nodding to the lags for the pace of hikes, but not for the end point. And that makes the chance that the Fed takes rates higher. That's why we revised our terminal rate, 5.5. QT is also continuing, so that can keep pressure on that belly of the curve or the 10-year. And that makes the chance of a hard landing higher. And I would say the market is under the impression it's a short, shallow recession. Well, if you don't get any monetary help, and I don't think we're going to get any fiscal easing, this idea of a short, shallow recession, I am pushing back against that. I think it need not be a 08 type recession, but a recession that can last for a while because you just don't get that policy support that I think we've been used to, that the market's been used to getting some help. And I think that help is going to be much harder in a high inflation environment.
Yeah, so the warning certainly elevated for investors who are out there. Priya, you pointed to the fact that there's always a lag factor with Fed policy, and we certainly heard from the Fed chair yesterday acknowledging that we're now into 4 straight jumbo size hikes. To what extent have we already seen that take hold, and how much of a lag factor are you looking at?
Sure. So I think there's a shorter lag between Fed policy and financial conditions. I think transparency, the dot plot, the communication from the Fed makes I think market price in Fed policy in a better way. Of course, Fed policy itself has been extremely hard to call. They've changed their dot plot significantly, every dot plot this year. But I think the financial conditions are pricing it in somewhat appropriately. I think what is unknown is how quickly does inflation come down. And if it is sticky, I do think there's going to be more financial conditions tightening, because that means that the Fed is going to keep going potentially even higher than our forecast of 5.5 on the terminal rate. But then there's the big question on when does the economy respond to it? And we've had this big wide savings buffer that the consumer has had. That buffer is dwindling. That buffer is dwindling. So over the course of next year, we think more in the second, third quarter that the consumer starts to pull back. And that's what will start to result in a recession. The labor market will start to cool down. So, I think the lags might be, there's a lot of talk that the lags might be shorter. I think for financial markets, I get that. But I think for the economy, the lags actually might be longer because the consumer has a savings buffer. So the labor market's going to look tight until that savings buffer is gone and service demand starts to slow down. And we think that's a second quarter, third quarter time frame next year. So, which is why the Fed has free rein to keep raising rates really into the face of a recession.
So either way you look at it, all signs pointing to more pain ahead. Priya, it's good to get your insights today. Priya Misra, TD Securities Managing Director and Global Head of Rates Strategy.